In No Fortress Energy, basically we've been with this company for a couple of years. We've been a financing partner. They put their liquid LNG products or vehicles into a JV. We provided the equity, but the bank market was shut. Typically, most folks would have to put their pencil down.
Yeah.
We really marshaled our resources and raised $1 billion for financing to have a successful transaction. So for us, these are the markets we thrive. Firm is doing extraordinary and hitting on all cylinders.
Jim, you said that the markets are closed, and they were for the most part until last month, where they reopened with a vengeance, and you saw everybody flood back to the market, money pile into even the most speculative debt, people basically sounding the all clear sign. What do you make of that, and how do you sort of adjust your view than perhaps in May when you said that recession was 1/3 to 2/3 of your base case, and you were talking about not taking that duration or liquidity risk?
Yeah. I think you got to differentiate between a rally in credit and the markets being open. The reality is, and it's been well publicized, that a lot of financing commitments have been hung, if you will, nowhere near what they were in 2008, probably 80 billion plus or minus versus the 400 to 500 billion. But new financing commitments are very challenging to secure today. We're a leader in private credit. We extend credit. We borrow in those markets as well. But the reality is the IG market's open, but the lower quality high yield market, still very few transactions are getting done. Very few new commitments are being made on buyouts. So it's not as clear as you said. Again, please don't differentiate a rally in credit versus really an open, thriving financing market.
Jim, can I ask you what you think of that rally in credit, though? 140 basis points of spread tightening on high yield in the last month alone. We've got guests lining up calling that wishful thinking. What do you call it?
Yeah. Well, it's interesting. We typically, when spreads go to 600, we usually, that's a buy signal for us historically. They were there for just a short period of time. As you said, they've rallied dramatically. It feels like the rally, I would say they're on the richer side of fair value than they are the attractive side of fair value. But I think it's interesting to contrast that to the private markets right now. You can, a year ago, high yield indexes were in the mid 4s, maybe touching 5. You can be part of a senior club in private credit right now with spreads, SOFR plus 650, which is basically almost touching 9.5%, 10%. High quality first lien position, top of the capital structure, 30-40 LTV. So that's an interesting marketplace. And we're open. We've been active at Apollo and at MidCap. The generic on the run high yield market, not particularly interesting. And I suspect you're right. Lisa mentioned I was of the view that a recession was in the cards in 23.
Yeah.
We still believe it will be. I don't think it's going to be a deep historical recession. As we all know, the numbers right now, you're having negative GDP numbers with 400,000 new employment per month. So it's not your father's recession by any means. It's a different kind of environment. But from our perspective, if you have the ability to navigate, it is quite interesting, as many are on pause.
Jim, I've got 20 seconds to squeeze this in. This is the question where the person behind your camera starts waving their hand saying, don't answer it. You were considering helping Elon Musk finance that Twitter bid. Given how it's fallen apart, has that left a bit of taste in your mouth around doing business with him potentially in the future? Just a yes or no, your thoughts on it?
We're a big player in the global financing markets. We finance lots of folks. We're very thoughtful about what we do. And we got a long-term track record to prove that out.
Everyone in that room is going to be very happy with that answer, Jim.
He read that off a cue card.
I'm sure they had it written down.
John, Zelter read that off a cue card like Powell does at a press conference.
Good job.
Hey, Jim, thank you. Fantastic to catch up with you. Some insight there into the credit markets and beyond. Jim Zelter there of Apollo Asset Management from New York City. Jobless claims in America up next. Futures positive 0.1% on the S&P 500. We're up about 1/10 on the NASDAQ too. Yields come in 3 basis points, 267 on a 10-year. Mike McKee, ready to break down the data. We'll do that next. This is Bloomberg.
Tech reports earnings.
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they are not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
'People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
Seconds away, live from New York City this morning. Good morning. Futures positive 0.1% on the S&P. On the Nasdaq, up about 0.2% now. Yields are lower by 4 basis points on a 10-year to 266.66 on a US 10-year. With some data in America, here's Mike McKee.
Good morning, John. Well, it is the same story with jobless claims that we've seen the last couple of weeks. A small rise, 260,000. The number last week was 256. Now, that's not the revised number. The revised number we're waiting for to come up here in just a second, and we'll see what that was. The trade balance comes in lower than forecast at $79.6 billion, down from 85.5. The forecast was for 80, pretty much flat. So that is another addition, since that's a June number, to second quarter growth, which is not a bad thing. We're down 5,000, a decrease of 5,000 in the jobless claims numbers last week. This week, we are waiting to see where we come up with the new number in terms of what the change was. Now, the important number here is becoming different. It's going to become continuing claims from now on. We want to know, if you lose a job, are you getting a job with all of these openings? And we do see continuing claims rise to 1,416,000 from 1,368,000. So an increase there. That's a trend to keep an eye on, because with all the job openings that we have, in theory, the Fed's theory is that if you lose your job, you can get another one. So we will watch continuing claims, how many people are still getting claims. Now I got this number. Last week, 260, they revised it to, so 254 rather. So now it's an increase of 6,000 from the previous week.
I want to talk to you about your tip point with all your years of experience and that you've had more meals at the Pioneer Grill at Jackson Hole than anybody I know. I want to know your tip point on claims. Is it 280, as we heard from guests this week, or is it a higher number, a more tense number from you?
I think it would be a higher number, but the other thing I would say is that I would be watching the continuing claims now, because if we do see people lose jobs, and this is the Fed's theory, if we see people lose jobs, there's so many job openings, you can probably get another job. So we'll keep an eye on the labor force and whether or not people who move into unemployment are moving off again relatively rapidly.
Mike, just quickly here on the trade balance, because this is something that I've been looking at in terms of the shipping costs that have gone down dramatically, especially for the United States. How much is this all just a foreign exchange influence that basically that is a disinflationary force where the U.S. is able to export a lot more in dollar terms based on the adjustments there?
Well, it's interesting, Lisa, because what we're seeing is a larger percentage rise generally in exports than imports, which is not what you'd expect on a foreign exchange basis. So at this point, that's helping the U.S. bring down its trade deficit. Have to see why that is and whether that's going to continue. We have, I know, seen more Boeing shipments, and those are very expensive than people had anticipated. So it could be something involving transportation, but it is kind of interesting. Last month, we saw a big drop in imported cars into the United States, in Canada or Mexico or the U.S. So that may be what's accounting for part of that as well.
Mike McKee, thank you. 260 is the number then. The previous number, 254. That's your revised number, 254. Claims heading in the wrong direction then. Very subtle move, though, up about 6,000 over the week. On the week. Futures right now, up 0.1% on the S&P. Tom, on the NASDAQ 100, up a little more than 0.1% as well. So we grind out another morning of gains potentially. Yields lower by 3 or 4 basis points on a 10-year.
And John, but very importantly, look what 2s10s does. It gets right down to the pre and misra mark. I mean, there we are, 39 basis points.
There's your move, Tom.
I mean, it's just simple.
It's a big move.
Inversion.
Look, when Priya said this on this show a number of weeks ago, Tom, it sounded pretty out there.
More inversion.
Here we are.
We begin our jobs coverage now. We do it with our great Michael McKee, and then we move to Thomas Porcelli. Tom Porcelli is chief U.S. economist at RBC Capital Markets and first came to my attention with absolutely brilliant study of the wage dynamics of the United States of America. Tom Porcelli, good morning. I want to talk to you about what we just heard from Professor Blanchflower at Dartmouth, where he said basically a linkage of these tumultuous times into wage growth is unfounded. Give us your update on America's wage growth in this 9% inflation we're facing.
I completely agree with his assessment. I think that people that are comparing today to the 70s/80s, I think that they're doing us a disservice. I think that this probably has much more in common with the 40s than it does the 70s. I don't think that this is some wage price spiral that the Fed is trying to or can impact. I think that that effort will bear very little fruit. I think the Fed is hiking pretty aggressively into an economy that's very clearly slowing down. I don't know how that ends well. I think, you know, if their thought process is, well, we got to really tamp down on wage pressures, I don't know how much more you want to tamp down on those. I mean, in in real terms, they're deeply in negative territory. I mean, I always sort of marvel at the idea that I think very few people appreciate that disposable personal income, nominally, in nominal terms, from the beginning of the year to today, is really up only modestly, nominal. But in real terms, you're deeply in negative. So that whole idea, I think, is sort of foolish. And I would say one last thing, Tom, and then I'll stop. You know, this idea, and Mike McKee was talking about this a moment ago, you know, he's right. Make no mistake, in certain industries, that is still true. But job openings are not the thing we're supposed to be hanging our hat on. It's a massive lagging indicator. They fall in earnest in the midst of a recession. In other words, they're a free option for companies. And we're already seeing them slow now in a more meaningful way. So, you know, this idea, and by the way, sorry, one last thing on that. This idea, too, that there's, you know, 2 job openings for every person unemployed, that is not correct. You have to look at people also that are not in the labor force that want a job, right? A completely separate metric. And when you add that to the number of unemployed, what you actually see is that the ratio is actually 1 for 1. And actually, just to be clear, it was 1 for 1 prior to the most recent job openings number. Now it's less than that. So I have no sympathy for that view in any way.
So Tom, translate that picture into what we're expecting tomorrow with the jobs report that we get out there and the anecdotal data that we're getting from a number of companies that they are starting to cut back workers.
Yeah, Lisa, I think that's exactly right. I mean, again, I know you guys were talking about jobless claims, what number starts to scare you. I don't know why you're not scared now. I mean, it's, you don't have to wait for some magical 280 or 300. I mean, you're up from 166,000, right? That was the low that we hit in mid-March. And so from that point to today, we're now up 50%. Now, I know the standard retort on that is, hey, but we're coming off of really low levels. Okay, you were coming off of really low levels in 01 too. I mean, they were historically low then, but hey, we managed to actually lose jobs and the unemployment rate wound up rising. So the level thing is not compelling, it's the move, right? It's the delta. And the delta is incredibly compelling. You're up 50% from the low. And sorry, just to be clear on that. So if you look back to every recession, we went back to the recession that started in 1969. If you look at every recession, from the low into that recession, you're up about 30%. Here we are up 50%. And yes, I know there's some seasonal thing, I get all of that, but even if you adjust for that, you're still up wildly. I mean, it's not a good outcome.
A lot of people would argue that you're coming from a point where everybody had been taken out of the workforce and then brought back in this sort of artificial breach as a result of the pandemic and the global economy shutting down. As we look forward, is your argument that the Fed should look through this and stand pat, not raise rates that much or at all, and sort of wait to see what happens, even in the face of 9.1% headline CPI?
I have a lot of sympathy for lifting rates. I think, look, and you all have heard me say this before. I mean, I think the Fed was very, very late to this. I mean, I would argue that today we should be 100 basis points higher because the Fed was much more aggressive, sort of late last year. But so I do have a lot of sympathy for that. I just think that we have to be careful and ask aloud, do you think that these interest rate hikes are actually going to scale back on inflation? I think inflation is going to slow organically. I know that's a tough pill to swallow for the Fed, and I know they can't stand idly by and wait for that to happen. So they have to keep on raising rates. I just think we have to be careful about the level of rates that we get to. I don't know that we have to get wildly into restrictive territory. I mean, look, let's be clear. Prior to things starting to turn pretty squishy over the last few months, the backdrop did not need any accommodation. I mean, we should have been at neutral a while ago. But I think now we're in so many ways, I feel like we're fighting yesterday's war on inflation. And moreover, I would add, there's certain components of inflation that have been doing some pretty heavy lifting that the Fed has zero ability to control, whether that's food or energy, things that are obviously now receding to some extent. But I think about some of the inflation components over the last month or two, like auto insurance or car repair. I know that might sound like these small little things. They added like a tenth, right? They added a tenth or more to the headline, to the month-on-month gain. That's an enormous number that, again, the Fed has no ability to control. People went out and bought a bunch of used cars. They are breaking down and they need more insurance. I mean, what can the Fed do about that? So I just think the Fed has to be honest about the things that it can and cannot control.
Tom, I want to finish up with this.
Yeah.
The Federal Reserve and where Fed funds peaks. Where does it peak for the team over at RBC?
Yeah, so we think you get to the midpoint would be 3.375. So basically, they hike over the balance of this year. We think that that's reasonable still at this point. I know it's probably sort of in line with what the market is saying. I don't know if I like that or not, but that's where we are right now.
Hey, Tom, it's awesome to catch up. Thank you, sir. Tom Porcelli
Thanks,
of RBC Capital Markets. TK with some strong thoughts on jobless claims. Heading in the wrong direction over the last few months.
Well, it's a trend. That's all there is to it. And, that'll play out. But far more important is the jobs report tomorrow. Are we all three here for the report tomorrow,
We
John?
are in for payrolls. Lisa and I are always here.
Oh.
It's you that's questionable at times on Payrolls Friday. You're going to be here?
Yeah, I'm going to be here.
Looking forward to it.
I'm not going beige suit, though. It's a serious day.
You'll prep for tomorrow. No baseball, right?
Today was not a serious day.
He's not taking today seriously at all.
The tang will be stronger.
No, because it wasn't Jobless Claims Thursday.
Yeah.
When the man from Del Monte walks into the studio to cover markets, I question how serious he is.
Yeah.
Coming up in the next hour, you asked for that,
tomorrow,
you did.
No
Troy Gajewski of FS Investments in the next hour, alongside Chris Harvey of Wells Fargo. and rubber banks, Jane Foley. You're impossible to ignore. You know that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Bank of England is warning that the UK is heading for more than a year of recession. That came today as the central bank raised interest rates by the most in 27 years, a half percentage point. BOE policymakers also estimated that inflation may peak in October at 13.3%. And in the UK, Foreign Secretary Liz Truss has rebounded from an embarrassing policy U-turn to regain the momentum in that race to become Prime Minister. Truss received the backing of former Chancellor Sajid Javid. That is a blow to her rival Rishi Sunak. Javid wrote in the Times newspaper that Truss would challenge the status quo and deliver immediate tax cuts. Bloomberg's learned the Biden administration is lobbying Democratic senators against a bill that would alter U.S. policy towards Taiwan. Amongst other things, it would designate Taiwan as a major non-NATO ally. Tensions between the U.S. and China were exacerbated this week by House Speaker Nancy Pelosi's visit to Taiwan. In response, China began military drills around the island today. And Amgen has agreed to pay $3.7 billion for ChemoCentryx. It's a biotech company focused on developing drugs for autoimmune diseases, inflammatory diseases, and cancer. Amgen will pay $52 a share in cash. That is more than twice ChemoCentryx's closing price on Wednesday. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
We think 9%, we're kind of trending around 9%, maybe 8.8 for the next few months. By year end, somewhere around 7%. But the year-on-year comparisons get much easier next year. And that's the key. And you don't need outright price declines, right? The levels don't have to decline. Just the month-to-month change has to slow.
Kathleen Bush-Johnson, she was absolutely lights out yesterday, Lisa, with Oxford Economics. I just thought she was great, piling into this jobs report tomorrow.
Yeah, and it's really an interesting moment when there are a lot of people saying that this is the key indicator the Fed will be watching to determine how quickly they can back away from some of those rate hikes that they've basically forecast.
Sterling with a little bit of a rebound, a 120 up to a 120.105, but still the shock of the Bank of England meeting. We've got the claims report coming out, U.S. futures up 7, etc., but also the churn in Washington. And there's so many themes we've covered this morning. Right now, we are advantaged with Greg Valliere. He is Chief U.S. Policy Strategist at AGF Investments. And Greg, I really want to go to the broader tone. I want to go away from what I read in the Washington Post and the great Bloomberg politics people to the senator from Wisconsin who was talking up like he owns the high ground. And Ron Johnson beat Feingold, the Democrat, by 50.2% of the vote the last time around. And Ron Johnson's coming out with statements that you and others would suggest really cause risks to the Republicans.
Well, I tell you, Tom, this has got to be Mitch McConnell's worst nightmare. He's got some bad candidates in Georgia, Pennsylvania, Ohio. They have overdone the abortion issue, which I think has backfired on them, as we certainly saw in Kansas. And you're right, Tom. Here comes Ron Johnson of Wisconsin, who says yesterday, maybe we have to change the structure of Social Security, make it something that has to be renewed every year, which would be a nightmare, of course. People would use that as a hostage for other legislation. I mean, are they trying to blow the Senate election this fall? I mean, the House is going to flip to the Republicans. I think that's pretty likely. But all of a sudden, the Senate is very much in play, and Johnson is a factor in this.
Is there a middle ground for Republicans? I think with Taiwan, we saw that with Mr. Romney, maybe taking a different tack than Rubio and other Republicans. But can McConnell and the Republicans find a middle ground that can salvage their Senate election?
I think so. There are an awful lot of Republican Senate candidates who are saying they would not support Mitch McConnell for another term as the leader of the Republican leader of the Senate. So it's a very, very divided party right now. And I think this is a shocker to all of a sudden see 3 or 4 or even 5 Republican seats look shaky, and maybe only a couple of Democratic seats look shaky. In a 50-50 Senate, the Democrats have a path to keep control.
This comes at a time, Greg, where the Democrats are trying to push through the Inflation Relief Act of 2022, the reshaped Build Back Better bill, and reframed in a new way for a new moment. How much do you view this as a likelihood, and how much do you view this as actually helping the Democrats heading into the midterms?
Well, I tell you, Lisa, all of a sudden you've got to conclude this bill is in trouble. Some provisions are going to have to go. Kyrsten Sinema, the moderate Democrat from Arizona, does not like anything on carried interest. I've been joking that carried interest is like Rasputin, cannot be killed. And it looks like this may wind up staying in the bill. She also, I think, has problems with the corporate minimum tax of 15%. So I think the bill is going to have to be rewritten to a certain extent. They were planning to leave tomorrow in the Senate. That can't be done and hoping to get a bill. It could be after Labor Day before a bill is done. And I think the bill could get even smaller.
There's a broader question here about the ability of this Washington to take fiscal action at a time of inflation as we head into a lot of what people are saying is going to be a recession. You see this over at the Bank of England, that they are hiking rates today. There is an expectation on the fiscal side there will be aid to offset the pain from that felt by the consumer. In the United States, is that kind of fiscal support off the table because of the politics right now and because of what the spending, how it was perceived during the pandemic?
How is this for an irony, Lisa? You've got very restrictive monetary policy now and restrictive fiscal policy just as we come close to a recession when maybe you could use a little stimulus. So, yeah, I think that the mood in Congress is to not spend much more money.
Greg, one last question here. We've got so much going on today. What is the legacy that Speaker Pelosi earned from this trip to Taiwan?
I can't figure it out, Tom. I don't know why she did it. A lot of people in the Biden administration asked her not to do it. I know she feels strongly about human rights in Tiananmen Square, but I think she stirred the pot in a way that was not constructive.
Greg Villiers, thank you so much. We value your notes each morning. And of course, folks, we protect the copyright of all of our guests. Look to AGF Investments Toronto and somewhere. He's in a shack up in New Hampshire somewhere. AGF Investments will get you the reports of Greg Villiers as well. Lisa, I don't even know where to begin on today. What is your thought as you look at the Bloomberg screen?
Well, just the resilience of stocks amid pretty much a consensus of gloom when it comes to the economic picture. Stocks are not the economy, and you do see an incredible bifurcation in terms of the income tiers. There was a Wall Street Journal article recently highlighting the savings rate for the lowest income, the middle income, upper middle income, and upper tier of American households. The wealthy are doing well. Their savings are being built out dramatically. The poor actually built up more during the pandemic because of the checks. The upper middle class is getting squeezed on every level, building debts, not being able to spend as much in real terms. And how does this bleed out in an economy that is really an economy of averages that really gloss over some of the nuance on.
And Tom Porcelli mentioned that with the real wage or lack thereof, and the scale of it, I should say, as well. I hate to do this, Lisa, but I think we've got to talk about Pharaoh's United Kingdom today. I knew it'd be a big deal, but I just simply, the language that we heard from Governor Bailey, for those just tuning in, absolutely original. You'd never see that by the Fed.
Lee Farage of State Street came on the show earlier this hour and said it was a bellwether moment to have a major central bank come out, hike rates by 50 basis points, and project a deep recession that had staying power. This shows the conundrum that banks are in as they face a stagflation type of environment. It is incredibly difficult, and it is something you're going to see in different shades, in different tones around the world.
Incredibly popular demand has forced the three of us to be with you tomorrow morning, and I have to believe it will be a more than important jobs report. Lisa, I'm going to be looking at the revisions, the look back one time, the look back two times, and adjusting those revisions into the pretty good number we're going to see as well.
I'm going to be watching wages. That gives a sense of how much pressure there is. Anecdotally, we are hearing about cutbacks. Walmart cutting about 200 corporate jobs. A number of companies have come out and talked about retracements. How much is it one-off? How much is it industry-specific? And how much do you see that in how much people are demanding higher wages and actually getting them?
And with the Bloomberg reporting this morning, perhaps a small cutback in Zurich as well at Credit Suisse. That'll be one of our themes of coverage today on radio and television. We are steeled for the jobs report tomorrow. We hope you'll join us. We'll start in strong with the usual victims with us. Looking forward to that. See you tomorrow. Alan Blinder at 12 noon today. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
No one covers the world like Bloomberg.
There's a sense they'll get to 7% in the coming months. Do you see that coming true?
Federal Reserve, of course, raising interest rates by 75 basis points again.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This market is laughing in the face of the hawkish Fed talk. Live from New York City this morning. Good morning, good morning. Another rally on our hands. We inch higher by about 0.2% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Farrow.
Live from New York, we begin with the big issue, climbing the wall of doubt.
With the rally that we've seen so far.
The big question is, okay, now what?
Well, we don't know. Possibly going through a bear market rally, possibly starting a very real new bull market rally.
But right now it's all about earnings.
Earnings are cranking away.
We're making our way through earnings season.
This season so far has been, again, one more, really pretty good season.
A relatively solid earnings season.
Yeah, you're going to start seeing equities get supported.
But the problems are still with us.
We may or may not be in a recession.
A lot of data is still out there.
Core, headline, CPI, PC, whatever. It's all some huge number.
We're still expecting the Fed to raise rates.
Investors don't know exactly how this script is going to play out.
A lot of answers we still need.
Joining us now is Rabobank's Jane Foley, Troy Gajewski of FS Investments. Jane, first to you. The Fed was comfortable with choppy June markets. Does it hate markets in July and August?
Oh, well, I think some of the economic data has been a bit better from the US recently, or certainly if you look at yesterday's numbers. And of course, those earnings seasons are higher too, but, the fundamentals remain the same. That the Federal Reserve, the commentary that we've had this week suggests that the Fed is going to be still pretty aggressive in terms of getting inflation down, acting on policy, trying to get those inflation expectations down to stop those second-order inflation effects. So I think the equity market rallies are still quite brave in this environment. I still think there's an awful lot of negative news still to come from interest rates particularly.
The performance off the June lows, Troy Gajewski, has been phenomenal. Up almost 20% from the lows of June on the Nasdaq 100, up around about 13% on the S&P. Consumer discretionary, I keep going back to that. It's up about 25% from the June low. Troy, I'll ask the same question to you. Why are market stocks laughing in the face of this Fed speak of the last week?
Well, look, bottom line, sentiment was very negative in June for very good reasons. Not only a slowing economy that with recession risk going up substantially, but also a Federal Reserve that, as you know, is going to tighten aggressively, already has started that. But bear market rallies are classic attributes of bear markets. When you look back at history, you typically had the strongest rally in bear markets where you get marginally less bad news. In this case, it was, markets really grasping at the new concept of neutral, being close to neutral in the last Fed announcement by Powell or discussion afterwards. But the reality is markets are laughing at the Fed right now, and the Fed has a tough job because they have to tighten financial conditions. When we look forward, we're hopeful that CPI can get to 7% by the end of the year, maybe a smidge lower. That's obviously unacceptable. The looser financial conditions are, the more it steals the resolve of the Fed to tighten even more aggressively. And John, maybe, just maybe, the month of August, they'll actually hit their QT target finally and start getting more aggressive with the balance sheet drainage.
Yeah, I've had a lot of questions about that privately behind the scenes as to what is actually happening with that balance sheet. Jane, for a central bank that doesn't want to offer forward guidance, they've offered a lot of forward guidance over the last 24 hours, haven't they?
It would certainly seem that way. And it's quite interesting because the lack of forward guidance seems to be the topic that several central banks are going down. You could accuse the RBA, certainly the ECB, of not wanting to produce forward guidance in the same way, making policies data-driven. But certainly, if we look at the Federal Reserve commentary from the start of the week, it has been hawkish, and there has been a fairly large amount of candid outlooks from some of these federal bank members. And what are the markets taking away from that? Well, they've taken away from the fact that 75 basis points could still be coming again, maybe in September. It's not totally out of vision for that. So, markets, I think, are preparing, certainly in the bond market, for maybe more in terms of interest rate hikes. And I think equity investors, need to keep an eye on that.
Equity investors confronting right now a wall of doubt and climbing over it with ease. Every single note I read is saying the same thing at the moment. Here's the note from Goldman and Goldman Sachs' Cecilia Mariotti. She says, without clear signs of a positive shift in macro momentum, temporary re-risking could actually increase risks of another leg lower in the market rather than signal the end of the bear market. Over at HSBC, Max Kettner wrote this: for this buy anything rally to continue, we need to see further repricing of rate hike expectations and another sharp drop in real yields. But market pricing of risk assets is now very much out of line with our cyclical growth indicators. Barclays joins the party. The emerging Goldilocks narrative for equities is that bad data and peak inflation will prompt more dovish central banks. We are skeptical and would fade the rally. We're bearish. Sentiment positioning can extend the short squeeze. Troy, what if the bulls are right? Can we just consider that for a moment? What if Marko Kolanovic over at JP Morgan is just right, that the peak horse story is in, and from here it's about recovery for this equity market?
Well, I hope he would be right now instead of coming into the year when he was wildly bullish. But look, there's always a non-zero probability that the fundamentals or all the fundamental analysis is wrong, right? When we look forward, the only thing we can think of, and there's very few, is that, remember, nominal GDP is growing much, much faster than real GDP. Revenue comes in nominal GDP. Margins are compressing, but are they going to compress fast enough into a slower economy to lead to meaningfully lower earnings? We think we have the answer in a recession. Obviously, earnings are going down. The question is to what degree. But if the Fed can thread the needle and nominal GDP dwarfs real GDP enough and margins don't compress substantially, that could in fact mean we hit at least a local bottom in June, but it's still highly, highly unlikely we've hit the bottom of this incredible bear market that's primarily driven by exceptional inflation and very aggressive Fed tightening, and now, unfortunately, a much, much weaker economic environment.
And we've got an easing of financial conditions over the last month in a material way. Not just the equity market, but credit spreads in high yield have tightened about 140 basis points in a single month. In the same month, they were all discussing more rate hikes and potentially a recession in America. Go figure. Futures right now fade a little bit. They're positive by almost a tenth on the S&P, up by a little more on the NASDAQ. Let's get to Taylor Riggs for a little bit more on this market jittery phase for the investor base. Hey, Taylor.
And some easing of those financial conditions, John. So when you take a look at the last few weeks and the rebound that we've had within the equity market as well, despite, as you also mentioned, a huge lift up, back up in yields earlier this week. Again, sort of a 20 basis point move and then a little bit of an additional lift yesterday, at least on the front end of the curve. So in the last few weeks, you've had some significant gains in terms of equities higher and bond yields trying to find their footing here within a 10-year yield. When you think about the bottom, John, and I love that you were talking about some of the bullish notes out there, is how much of this relates to sort of the bottom line and coming out of earnings season? There was a great note out this morning that we're still 6 to 7% higher in terms of earnings per share than we were at the January high. So a lot of people are saying that we still have a lot more room to run. This is actually more just a big bear market rally, because in previous recessions, you really need to start to see those earnings per share really start to come down, and we are nowhere near there. When we think about some of the positioning, look at the terminal chart. I think it was interesting. The AAII survey had sort of signaled this as well. You're a little bit higher on the week, but still looking at 18 straight weeks of sort of the bearish positioning. And this highlights this here as well, right? Sort of how we're thinking about sort of our outlook here. Some of the bearish levels that we haven't seen now actually going back since 2016, John.
Taylor, thank you. I want to come to you, Jane, just on some of the economic data away from some of the market stuff. Yesterday, S&P Global had a PMI for services. It was terrible. We ignored that. We focused on ISM services, which was great. Why is that, Jane?
Sometimes the market sees what it wants to see, and then certainly if the market was, in the appetite for buying a little bit of risk, then it would have probably focused on that. But ultimately, I think the data will come out in the wash. Everything that is in there will eventually run through. And I think, generally speaking, if we step back, the market is looking ahead to slower growth for the US into next year, and of course weaker growth globally as well. From China, from the Eurozone, and certainly, of course, from the UK. So, this is not an infrequent thing to happen, the market focusing on what it wants to see. But again, it's part of perhaps a short-term outlook rather than, looking in the big picture.
Jenny, are you expecting that ISM to come down to where that S&P Global PMI ultimately is? Is that how that gap closes from your standpoint?
Yeah, that eventually does happen. I mean, we can see that in lots of bigger surveys. If you look, for instance, in, the various measures of labour, eventually when we stand back, we wait for all the revisions to come through, then they generally tell the same sort of story. And I think given that the Fed has been hiking, given the strength of the US dollar, given the early signs that we've seen of labour market loosening and various different indicators, I think that's exactly what will happen.
Troy, no real sign of a Fed pivot. The data's weaker. I'll catch up with Mike McKee in about 5 minutes' time. We'll talk about jobless claims. They're heading in the wrong direction. I've asked a few guests this question, Troy. I'll ask it of you. What business do high yield spreads have tightening 140 basis points in a single month?
Yeah, unfortunately, very little business unless we can avoid a recession. If the Fed can thread the needle, perhaps we've seen the wides and spreads this cycle. Although, again, if you look at what the Fed is forecasting for balance sheet drainage, it's 4.5 times the pace of the last QT, 3.6 times in terms of nominal GDP, and 2.9 times in terms of existing money supply. So that alone, we think, should drive wider wides and high yield. But clearly the tightening, back to your positioning discussions before, just alongside equities, we had extreme bearish sentiment. There hasn't been a lot of new supply, which over the medium to long term is obviously tough for the economy, but it means you could set up for a bear market rally there. And John, what happens in recessions. High yield goes to 1,000 to 1,200 over. It obviously got meaningfully wider in the GFC and the pandemic, but no one's calling for that. So in a recessionary outcome, clearly high yield spreads are going wider.
Well, the Bank of England is forecasting a big recession over in the UK, starts Q4 and goes through the whole of 2023. Jane, first question I asked myself when I saw these forecasts from the BOE this morning, 13% inflation, recession from Q4 this year through next year. Can you imagine the Fed forecasting the same thing, Jane? What did you make of that?
No, it's incredibly candid from the Bank of England, incredibly candid language that we don't generally get. Sometimes you get this candid language from the Riksbank, sometimes from the Aussie or the RBNZ, but generally not from the Bank of England. It is very worrying to see the data that they're talking about, a 13% print on inflation by the end of the year, and then several quarters of recession. For many UK economists or many UK watchers, though, it's not an enormous surprise. There's been a lot of very gloomy indicators already from the UK, and I think one thing's for certain is that the UK is sort of further into the growth slowdown phase of the economic recovery than other G10 nations. We've had for a while, the forecast from the OECD that the UK economy will perform the worst in the G20 bar Russia. No growth at all, it's forecasting for next year. So a lot of the gloominess is in the price, but it's still quite startling to see this sort of language from the Bank of England today.
I've heard some people say they're just being more upfront and honest about what they think is going to happen in the future. Jane Foley, Troy Gajewski, they're going to be sticking with us. I want to get you some movers ahead of the opening bell. Futures slightly positive. Here's Abby with more. Hey, Abby.
Hey, John. Well, those futures are slightly positive, ever so slightly, but we've got bigger movers beneath the surface. Starting out with the shares of Cigna, they are popping sharply higher this after the insurance company put up a better second quarter than expected. They also raised the 2022 operating profit outlook as non-emergency medical procedures. They're not as happening as much, so it brings down the company's expenses. ConocoPhillips up 2.4%, a better second quarter, similar to Chevron and Exxon, and despite guidance for higher costs, they are boosting buybacks and offering a higher dividend, investors liking it. On the downside, though, Lucid Group, the luxury car maker, plunging down more than 12% as it halves its EV production targets for a second time this year to 6,000 to 7,000 vehicles produced this year from the original of 20,000. Somewhat related, just crossing the tape now, Nikola, they put up a better quarter than expected. That stock popping by 5%, and then Toyota down 3%. They are sinking. That stock is sinking, John, after the company said it is sticking with what is considered to be its conservative profit outlook.
Abby, thank you. In the commodity market, we've got a break of 90, 89.92 on WTI. We're down 0.8%. That's a break below $90 a barrel on WTI for the first time since the invasion of Ukraine. Crude breaking down on Brent, we're down 1% to 95.75. Coming up, Fed officials doubling down on their pledge to curb inflation.
Whether we are technically in a recession right now or not, it doesn't change my analysis. So I'm focused on inflation.
A lot of forward guidance from a central bank telling you they're not going to provide forward guidance. That conversation up next.
Record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the science behind the recent heat wave.
It's going to get more extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. This week, will we see the first cracks in the labor market?
There's another shoe out there to drop.
Will the labor economy break?
Can the Fed deflate the demand for labor in the economy without pushing up unemployment?
This Friday, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
We still have a lot of slack in the labor market.
The labor market is going to be seen as to whether it keeps the light green on go, go, go for this Fed.
The July Jobs Report, Friday on Bloomberg Television and Radio.
We are laser focused on getting inflation down. And, whether we are technically in a recession right now or not, it doesn't change my analysis. I'm focused on inflation and where inflation is likely going. And that to me is what we have, my opinion is what we have to focus on right now.
That was Neil Kashkari, the Fed president over at Minneapolis, just one of the many central bankers over at the Fed, pushing back against the policy pivot this week, focusing on inflation, even at the risk of recession, with less than 24 hours until the payrolls report here in America. Let's get to Mike McKee for more. Hey, Mike.
Hi, John. There's an old saying, don't fight the Fed. Is anybody listening to what the Fed is saying these days? You take a look at the bond market and you see what's happening with 10-year yields. They've gone down, and that pulls down the blue line, which is the financial conditions index. So as the Fed tightens, we're seeing conditions get looser, and they're way below the yellow line there, which is where the Fed says its base rate is going to be at the end of next year. So what's going to influence the markets? Well, we have a jobs report tomorrow that people are talking about. It is supposed to slow to 250,000. Will people take that as bad news? The 5 years before the pandemic, the average on a monthly basis was 193,000. Unemployment averaged 4.4%. We're at 3.6% now. So there's some room to give where the Fed could bring it in for a soft landing. But right now, the markets are not believing that. Take a look at this number here. This is claims, and this is the jobs number, job creation number, and the claims, the CPI number rather, and the forecasts for both. And you can see that we are expecting inflation to go down, but jobs to stay steady, which is also good news for the Fed, but does not tell you why the market is doing what it's doing and pricing in a recession still.
Mike, I'm going to squeeze this in. People throw this question around a lot, so forgive me for throwing it around this morning. Is the Fed losing control a bit here?
Let's say the reins have loosened a little bit. The question is, do they come back? And that'll depend, as you say, on Fed speak, especially Jay Powell at the end of August.
Mike McKee, thank you. Payrolls tomorrow, then on to CPI next week. Two big data points for you over the next week. Right now, futures negative 0.1%. Then the question we're all trying to answer, is it too early for the labour market weakness to show up from the weakness elsewhere? Do we see the weakness elsewhere bleed into the labour market? Do we see that as soon as tomorrow? Matt Lazzetti of Deutsche Bank says this: I do think there's a potential for labour hoarding. That could mean that we don't see the effects in the labour market take place for a longer period of time. The view from Deutsche Bank there. Jane Foley, can I put that question to you? Do you expect the recent weakness we're seeing elsewhere to bleed into the labour market anytime soon?
Well, because we all know that the labour market is a lagged indicator. Hoarding is one reason, and also if we look back at for years, not just because of the pandemic, we've seen the amount of people in the labour force in the US has really dropped away. So that's another reason why firms might want to hoard. They might think, well, it took us ages to get back up to speed after the pandemic. We don't really want to allow these workers to go too easily. So yes, there is good reasons why economists see the labour market as being lagged. That said, if we look at initial claims already, there is a little bit of sign of loosening. If we look at the household survey, if we look at some of the indicators within the ISM survey, we can see a little bit of loosening in the labour market coming through. So I think we will see some, but perhaps, it's still going to be a pretty firm labour market overall in the next few months.
Troy, what do you reckon?
Yeah, well, look, clearly the labour market's starting to soften. The good news is, though, it started in a white hot zone and has drifted to red hot and now arguably to hot. And that's the main reason we haven't had worse economic outcomes so far, right? I mean, you look at every component to GDP was negative in the first half. You look over at Europe, Europe's obviously a disaster. China's a mess. The US consumer has single-handedly been keeping the global economy afloat. Unfortunately, if you extrapolate the recent labor trends forward, and we get 200 basis points more of unemployment from where we were recently, it's almost impossible to figure out how we don't have at least a mild recession. And, every data series we look at, particularly withholding tax growth and other factors on the tax side, which are more real time, points to a labor market that's softened significantly. And eventually it's hard for the U.S. consumer to do it single-handedly.
I asked Mike McKee whether the Fed was losing control. Jane, there's another question we should ask too, whether they're seeing what they want to see. Because jobless claims, yes, are climbing. We're taking some heat out of the labor market. I think that's very, very unfortunate, and we all agree with that, because no one wants to see job losses. They want to see job openings come down. They wanted to see inflation come down, crude south of $90 a barrel on WTI. Jane, can you help me understand the distinction between the things that are developing at the moment that the Fed doesn't want to see, and the Fed and the things that they're actually shooting for, the objective?
Well, we've got to remember that monetary policy is an extremely blunt tool. And clearly we all know that a lot of the inflation is supply driven. Not all. There are a number of instances of strong demand, particularly in the US. And in fact, there was a back of the envelope calculation from the Federal Reserve in the middle of July produced to say that demand, because of fiscal spending during the pandemic, reduced US inflation by something like 2.5 percentage points, really quite significant and more than elsewhere. So we know that we've had excess demand. The Fed can't control the supply side problems. It can control the demand. It's going to bring down demand. And yeah, okay, it would rather people remain in their jobs and job openings reduce. But the reality is that it can't fine tune the economy like that. The reality is that it will make the labor market worse. And that's part of the pass through of monetary policy to slow the economy, to bring equilibrium in supply and demand down to a lower price level, to bring inflation down. So inevitably, I think, and purposely, the job market will loosen in the coming months.
Jane Foley, Troy Garsky, to the both of you, thank you. Coming up on this programme, the morning calls, and later, from Bernstein to Goldman, sounded the alarm on the recent equity rally. How many banks are doing that right now? Chris Harvey of Wells Fargo is going to join us in about 7 minutes' time. Looking forward to that. It's just around the corner.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Live from New York, equity futures slightly negative, down 0.1%. Good morning to you. That's the price action. Here are your morning calls. Cowen downgrading coals to market perform, expecting a weaker and inflationary backdrop to drive EPS downside. UBS upgrading Southern Company to buy, seeing fresh growth opportunities after winning approval for its long-awaited nuclear power plant. And finally, Baird downgrading Under Armour to neutral, $10 price target, highlighting a challenging macro environment and poor earnings visibility. Coming up next, we'll catch up with Chris Harvey of Wells Fargo and why he thinks that weakness in corporate earnings isn't going to come until next year. That's next. This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
From New York City.
Here in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
How are you thinking about those dynamics?
25 seconds away from the opening bell in New York this Thursday morning. Good morning to you. Here's your price action. Slightly negative, down by 0.02% on the S&P. On the Nasdaq, totally unchanged after ripping almost 20% off the lows at the middle of June. What a rally we've seen on the Nasdaq 100. That's your opening bell. Switch on the board and get to the bond market. All over the place. Yields lower now by not even a basis point to 270.28, much higher at the front end. Curve inversion, 2s versus 10s on my screen, about negative 38 basis points at the moment. The euro showing some strength, euro dollar 101.84, and crude showing some weakness here. We're down more than 1 percentage point. It's a break of 90, 89.57 on WTI. About 15 seconds into this, let's get you some movers. Here's Abby.
John, let's start out with one of the big winners yesterday. Today, not so much. Of course, I'm talking about Meta, and we heard yesterday about the possibility of a bond offering. Well, it's now a reality. This is the company's first ever bond offering. It will come in 4 parts, and it could be as much as $10 billion. And actually, now you have the stock flipping ever so slightly higher. Alibaba soaring, though, up 6.3%. Sales were better than feared, a big beat for the company relative to low expectations. This despite a contraction in the Chinese economy. To the downside, though, Eli Lilly down 1.5% off of its pre-market lows. They missed second quarter revenue estimates. They also slashed the fiscal year adjusted earnings forecast. Looks like it's a combination of macro headwinds and pricing. And then finally, you were just talking about oil below $90 a barrel, below important support. That's weighing on the energy complex. As you know, the worst sector on the day, and Occidental Petroleum, one example of that, down 0.8%.
Abby, thank you. About a minute and 15 seconds into this, almost totally unchanged on the S&P 500. Big tech has been leading the rebound in equity markets over the last month, though. The Nasdaq 100, as I've said repeatedly, jumping about 19-20% from its June lows. Taylor Riggs has more. Hey, Taylor.
And John Authors, of course, our Bloomberg opinion columnist, says sort of maybe nicely that if you think about a bear market as a 20% decline, could a bull market be a 20% gain off of those lows? If so, using that loose definition, what a way we have come. As you mentioned, it's been all about big tech. The New York FANG index, the SOX index, the Nasdaq 100 really now up more from some of those sort of lows that we had mid-June, now 19, even 24% or so. A lot of this, as you've been mentioning, has to do with the yield story. We've been looking at a big rebound in the equity markets because in blue, it's been yields coming down. Of course, in the last few days, maybe a little bit of that narrative has changed, particularly on the front end. But in the last few weeks, it has really been a story of yields continuing to grind lower, helping to boost some of those long duration assets that is big tech. Finally, sort of on some of an individual mover level, we've been talking in the closing bell, pins for one, PayPal, of course, given sort of the Elliott investments, but Tesla, Amazon as well, sort of some of the big movers in there. You're up 20, sometimes even 40% on some of the individual names that have been fueling sort of the big rebound that we've been seeing as of late.
Unreal. We've absolutely ripped. Taylor, looking forward to the coverage at the close. As always, Taylor Riggs there. I've talked about a long list of strategists out in this rally. Max Kettner over at HSBC is one of them. This is what he's got to say. July's repricing higher of both risk-on and risk-off assets now leaves us with an unrealistic Goldilocks backdrop. We move to maximum underweight across equities, high yield and sovereigns, and are tactically overweight cash. Kaylee has more. Hey, Kaylee.
Hey, John. Well, they say all good things must come to an end, and a growing number of strategists, as you say, are saying that end is near for this equity market rally because, of course, Taylor was just running us through how far we've seen these stocks come off the lows, especially tech stocks. But what that has done is made them more expensive. When you look at historical PE, we are still well above that 20-year average. And Bernstein, one of the shops that is really focused on the denominator of that, on the earnings story, saying basically we're still really early in this downgrade cycle. That echoes what we heard from Bank of America earlier this week, which said, yes, we have seen forward estimates coming down, but not enough, considering they're still 6% above where they were when the equity market peaked back in January. And their data shows that in the last 4 recessions, the S&P only bottoms after EPS forecasts have fallen either to or below the level they were when the market peaked. So it's really pessimism about the forward view that is forming the bear case here, because, of course, the backward-looking view at the second quarter really hasn't been that bad. S&P earnings are up 9.7% year on year. Of course, a lot of that has to do with the outsized moves we have seen for profits for energy companies. But it's not just all about the earnings story either. You also have Goldman Sachs saying the path from here is likely to become more dependent on economic data. And without a clear positive shift in macro momentum, stocks could see another leg lower, John.
Kelly, thank you. Chris Harvey of Wells Fargo has a message to the bears. You're too early. This is what he's got to say. We do not expect to retest the lows until the first half of 23. Fed expectations toggling down, the lower cost of capital and second quarter earnings clarity has raised the equity market floor. First half of 23 may be tough for stocks. He goes on to say we may see operating margins collapse at exhausting consumer and the job picture turning for certain. Chris, I'm pleased to say, joins us right now. Chris, let's start there, buddy. And it's great to catch up with you, sir. Why do you think the bears are too early?
Well, again, it's exactly what we said. Right? Your cost of capital is down. We're through earnings. Earnings, even for us, as we look at margins, we expected margins to not be as strong as they were. And strong is the wrong word. We expected more compression. You didn't get it. But more importantly, the thing that we always talked about, the thing that we hung our hat on, it wasn't about a valuation. It wasn't about a level. It was about the Fed. And when the Fed was going to toggle things down, what we said and what we believe is equity market can sustain gains and equity market prices can go higher. And that's what we're seeing. And the last thing you touched on, and a few of the commentators touched on it, we are now in a growth market. Rates are coming down. That's really positive for growth and for the market in general, because the S&P is a long duration asset.
Chris, can that continue to work with inflation close to 9%?
All right, John. So let's talk about break-evens. Let's talk about inflation, and let's talk about what's happened over the last year. A year ago, we said this very loudly on the show a number of times. Last year at this point in time, I had never seen a pricing environment the way I had seen it last year. Everyone was raising prices, and the consumer was just price unconscious. Now we're seeing a consumer that is no longer price unconscious. They are making decisions, and they are changing their behavior. More so, if we look at break-evens from right across maturities have come down significantly. So the market's saying that cyclical component to inflation is coming down. If we look at some of the components in ISM recently, they've come off the boil. What we haven't seen is CPI. CPI is still running hot. We'll see. We get CPI a little less than a week from now, but ultimately what we're seeing inflation come down, and we should expect inflation to come down. It will be sticky. There are geopolitical reasons why it won't get to levels that we've seen in the past, but ultimately we're late in the cycle. The economy is slowing, demand is slowing down, and the consumer's behavior is changing. So again, expect to see inflation come down. It'll be a little bit tricky with CPI. We'll see what happens, but ultimately all the factors you need to see are occurring. And so we're in a much different camp with inflation today than we were a year ago.
Chris, help me out with the timing of this. And as you know better than most, the timing of anything is the most difficult part of the call. When do I start to transition away from what's working now towards what you're anticipating in the first half of next year?
Yeah. So John, what we said at the beginning of the year, we thought the first half of 2022 was going to be about defensives and cyclicality, reopening. In June, but we also said by the second half of this year, we're going to go into a growth market. We're in that growth market. In June, we downgraded cyclicality. And what we're telling clients is you really need to rinse the portfolio from cyclicality. What we're seeing on the value side is we're seeing what I consider a lot of value traps. Companies trading at mid-single digit earnings, okay? Whenever I've seen this that late in the cycle, what that is the market telling us those earnings that you see today are not going to exist in 6, 12, 18 months. You're going to get multiple expansion, but not the kind you like. So I think we're in a growth market. I think we'll stay in a growth market, but you also have to manage your risk. And there are parts of the low volume defensive sector that we do like, and you want a barbell growth with something either better balance sheets or a little less volatility.
Chris, I don't know what to do with discretionary. Can you tell me what to do with discretionary? I hear everybody talking about a bear market, a recession, and there we are ripping 25% off the June lows. And Chris, I just scratched my head at that. What are we doing?
Yeah, it's a good question because we're looking at that right now. We've been underweight retail for some time. That's worked very well, but you are seeing a balance. And we just looked at the performance of staples versus discretionary. And staples obviously have ripped over the last 6, 12 months versus discretionary. Right? And what we're seeing, getting back to margins, what we're seeing on the staple side, that's the area where we're seeing real margin pressure, right? And staples, discretionary looks like maybe it's in the bottoming process, maybe it beat the rush. So it's worth a look. We're not sure just yet, but we're going to do a lot more work in the space because prices have really turned. And multiples, in some cases, are trading at recessionary levels.
Someone's doing more than looking. They're buying tons of it, apparently. Chris, it's good to catch up. You're going to stick with us, I know. We're going to talk about some layoffs potentially in corporate America. Consumer discretionary right now up another third of 1%, leading the gains this morning. The S&P down by a little more than a tenth of 1% on the downside, as you might expect. It's energy down 2%, given the moves we're seeing in crude. When was the last time we talked about the 80s on WTI? We can do that right now. $89 a barrel on WTI and down 1.4% on the session. Coming up, investors gearing up for payrolls as corporate America continues shrinking its workforce.
Even though the economy is slowing down, we still have a really tight labor market, and there's still more jobs out there than workers.
Walmart's the latest. That conversation up next.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
Federal Reserve, of course, raising interest rates by 75 basis points again.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
And you're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
well,
6?
Maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood changing, the confidence boosting aspects, so the sort of tribal aspects of what fashion does. And so I went at 18 to Florence knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Even though the economy is slowing down, we still have a really tight labor market, and there's still more jobs out there than workers. So I think it is possible to cool the labor market and cool the economy without seeing a real large increase in unemployment. There is a way to kind of thread that needle, even if we have a bit of a mild recession.
Investors gearing up for Jobs Day in America. This as a growing list of companies continues hitting the brakes on hiring. Beyond Meat, following Walmart, the CEO writing the following: while difficult, this decision is one piece of our larger strategy to reduce operating expenses and support sustainable growth. Taylor Riggs has more. Hey, Taylor.
And John, like you said, just in the last 24 hours, a few companies, Walmart, of course, after the bill yesterday, saying a reduction of about 200 employees, but